Welcome back to Infinity Podcast. Today I'm joined by Brad Dockser, founder and CEO of GreenGen and a global leader at the intersection of real estate, energy, and capital markets. Brad has spent over 2 decades operating at the highest levels of institutional real estate, including senior leadership roles at Starwood Capital in Europe and Asia, and now advising many of the world's leading investment firms on how sustainability directly drives asset performance and long-term value. Brad, thank you for coming on the podcast.
Zeus, you're very welcome. Excited to be here.
So Brad, to start off, and for our listeners who don't know your background, how you got started in real estate, your sustainability background, could you guide us through how you got started and where you are now?
Yeah, absolutely. And I think it's interesting because I'm not a sustainability person. I'm not a climate person. I'm not a decarbonization person. I spent the first 20 years of my professional life as a real estate investor. So that's the perspective, that I've always had. I came out of college, I started at J&B Realty. At the time, J&B was the largest real estate firm in the country. I subsequently spent a decade at Starwood Capital and founded their international business in both Asia and Europe. And then the last real estate role that I had was running the East Coast for a group called McFarland Partners. That was an investment advisor backed by CalPERS. That was essentially doing impact investing before the term impact investing existed.
How did you come about sustainability then? If you started out in the traditional real estate investing role and world, how was your transition to this whole green movement?
Yeah, historically, real estate was a simple business. Almost all the discussion was about how do you drive the revenue, the top line. And in a sense, the expenses and the margin sort of magically happened. The GFC comes along, and all of a sudden now, for the first time, the simple model of driving your top line collapses as the GFC takes just a big chunk out of rents and occupancy. And as that was happening, we began to look at the bottom half of the income statement where expenses were. And essentially, we were looking at the expenses as a way to mitigate this collapse. And when we got to the energy line, there were a couple of observations that we saw. One, energy was bigger than we realized. Two, it was controllable. That seems very obvious today, but in fact, 15 years ago, there was not a perception, not a belief that energy was controllable. You got a bill, but now all of a sudden there was an opportunity to mitigate and control the expenses. And the final piece was that technology had become much more powerful. So there was finally a business case around integrating technology in the built environment. You drive your OpEx down, your EBITDA would go up. And if you did it right, you could drive both a financial outcome and a climate outcome at the same time. The challenge, Zeus, was that in fact, almost everybody in the industry was set up to tell you what to do. And real estate investors didn't need a plan or a strategy. They needed the plan and strategy executed, implemented, because that's where the value came from. And there was really nobody in the industry that was doing that 15 years ago. And so my wife and I, who had met at JMB and a third partner, founded GreenGen in 2011, really around the idea of creating an end-to-end approach where we not only helped develop the strategy at the organizational level, the fund level, the asset level, but then we actually executed it to drive increases in asset performance and decarbonization.
Can you tell us a little bit more about GreenGen and how it has evolved recently, like within the rise of AI and then obviously within the capital markets in today? Like how is it different from its inception up to today's day and age?
Let me start by talking about what it was at the beginning. At the beginning, the innovation that we had more than anything else was to change the semantics of decarbonization and sustainability. Instead of asking people to invest money to decarbonize, we basically said we're going to invest in the asset to drive the expenses down, the cash flow would go up, and you get this co-benefit of sustainability, decarbonization, resiliency, however you want to think about it. And the vast majority of investors, that's what they do. Good value-add investors spend all day long thinking about ways to basically put $1 in and get $3, $4, $5 out of an asset. That's the fundamental business. That's what good value-add investors do. The interesting thing was that for the most part, this category of spend, energy, electric, water, gas, and steam, and today increasingly repairs and maintenance and insurance, was not a focal point. So, and part of it was just helping to shift the mindset. Instead of people saying how much does it cost, we focus on how much value does it create. Now, the interesting thing about where we were in 2011 when we started the business to today is that probably the biggest difference is now there's an enormous amount of regulation at the city, state, national level. Generally speaking, that's not true at the U.S. level, the federal level, but the U.S. government has really never led on this. They've been supportive. In the U.S., all the action really is at the city and state level. In other places, in the EU, it's at the country level and the EU level. In Asia, it is really at the country level. In India, it is at the state level. And so, we've got all these stakeholders sort of pushing this. And I would say, the number one thing has been regulation. I think the other thing is that over the past 15 years, the perspective on physical climate risk has changed dramatically. And what that means is now all of a sudden there's a way to invest in the assets, to harden them, to make them more resilient, to make them better, if you will. That's very accretive to the value. Those things, more than anything else, I think are quite different. Now, you mentioned AI, and there's no question that AI is making a difference in sort of every part of our lives, including real estate investment, whether it's looking at markets or selecting assets. There are a number of companies that are using AI to do what I'll call the preliminary analysis of portfolios. What they're not doing, what they haven't been able to do, is replicate at the asset level, sort of that, whether it's an ASHRAE level 2 or decarbonization plan. That still requires really understanding the asset, looking at the energy loads, understanding rebates and incentives to put it all together, and of course understanding what the cap rate is, understanding the lease structure, how expenses are reimbursed, and working very quickly, because oftentimes owners are not long-term owners. They're going to have a 2 or 3 or 4 year perspective, and so you've got to move very quickly.
Thank you, Brad. You made a post yesterday about Local Law 97 in New York and then all the regulations behind that. Could you tell us a little bit more for the listeners who don't know what that is and then how it applies to the asset level for real estate?
Yeah, if you look across the U.S., there are more than 60 different municipalities that have some form of climate regulation, carbon taxes, reporting. New York City is one of them. Their regulation is called Local Law 97. In Washington, D.C., it's called BEPS. In Boston, it's called BERDO. Most of these are at the city level. There are some states like Maryland that have BEPS regulations. And then there's counties, like I'm sitting today in Bethesda, Maryland, in Montgomery County, Maryland. Montgomery County has a reporting requirement, and also it's the first county in the country to have a green bank. And so this is occurring at all different levels of local government. And what we're seeing is that more and more communities are creating laws and regulation to align with their values. Whether it is to reduce greenhouse gases, improve air quality and the overall community, whether it is to reduce energy so you don't have to have a peaker plant, or you can slow the necessity of adding additional generating capacity at the utility level. There are different motivations for it, but that's really what it's coming from. Again, no pressure, and it's never really existed at the federal level. All the action in the U.S. is at the city level. And what's happened in the recent years is that in the past, with a supportive federal government, many jurisdictions were saying, listen, make a best efforts. We get it. Maybe you won't get there today, and they'd give you sort of a pass, or they'd give you a stay, if you will, until the following year. That's largely gone. Now we're seeing fines, we're seeing increased fines, we're seeing a propensity to actually send the letters out and go forward with it. At the same time, more rebates, more incentives at the various levels. Here in Maryland, we have a green bank in Montgomery County and utility rebates. We also have a state green bank. We have a state energy administration, MEA. There might be 3 or 4 or 5 different public programs that can either reduce the cost or the cost of financing the work to incentivize you to do it. That doesn't apply everywhere in every market in the country, but I think Local Law 97 is a good example, probably the biggest, most aggressive example in the United States of local regulation that is intending to have really a very specific effect, which is to reduce overall demand on the grid and to improve air quality and other health outcomes by reducing greenhouse gases in the community.
Brad, I want to shift the conversation over to the capital markets side. Right now, where are you seeing the biggest disconnect between climate goals and capital allocation?
I think that, first of all, that's a great question. You know, we tend, our business on the private sector side is with big global investors. They lead with primarily ROI. And so think of it as climate alchemy. We put $1 into the climate machine or the GreenGen machine and $3 or $4 comes out. That's what they're after. They know there's going to be a co-benefit, but they're basically leading with that their fees that promote their carried interest are higher. I think the biggest disconnect is between people who inevitably the first place they go to is how much will it cost? We work very diligently to get them to a different first place, which is how much value will this create? Yes, office demand is down. And let's say it was at 90%, pre-COVID, now it's at say 80%. But the reality is that 80%, of office space is still being taken up. It is basically still being taken up by people who just want more from their space. So the occupiers want more, their employees want more, their customers want more, their supply chain, because a lot of people are reporting scope 3 because somebody else is reporting their supply chain, and then their investors, equity and debt, local officials, whether it's the people who are elected to a city council or appointed, planning office, etc. All of them are expecting a lot more from their space, and I think the biggest disconnect is people who don't understand that this is where it's going. It's not just about the EBITDA of the asset to improve the value of it, but it reduces potentially the cost of financing, higher proceeds, lower cost of capital, easier to raise debt or equity. And at the same time, we're seeing more and more that this is really impacting the market when people go to sell a building. And what I mean by that, we used to think that all that really mattered was things that happened during our hold period. But now we're selling to somebody who's essentially going to run a 10-year discounted cash flow. And so they need to know what the impact will be during their hold period and their exit, right? And so more and more, I'm not a big believer, Zeus, in the idea of a green premium. I'm a big believer in the idea of a brown discount. And what we see and what we believe is that if you don't address this, you'll see a bifurcation of the market upon exit between those assets that don't have a plan, or it's hard for investors to get their arms around what the vision might be, and those that have a plan, even if it's not fully executed, but there's a pathway, there's a plan, they have some costs, they know what the value will be and how it's going to impact the EBITDA.
Great points. Let's talk about scaling impact. I know that finance itself can be an enhancer to scale impact across the United States and the world. How do you see finance playing a role when it comes to scaling the impact across the real estate sector?
We don't have a capital markets issue in the US. There's enormous amounts of capital, whether it's to incentivize you, buy down the cost, but there's plenty of capital to help with this clean energy transition. I think the bigger challenge is business model. Like, we know how to put solar on the roof of a house. It's pretty easy. It doesn't, you buy panels, you buy the racking, you buy the inverter, you put it on, you interconnect with the utility. What we don't have is we don't necessarily have a good business model for doing a lot of these things. EV charging, solar energy efficiency, things like that. And so, the challenge is, how do we get the right programs? How do we create the right capital markets structures, if you will, to get this work carried out. So, again, not
Yeah.
it's a technical issue. We have the right technologies. Now, think of this as sort of the Bill Gates. We don't have the right technologies, or Jigar Shah, who founded Generate Capital and previously ran the Department of Energy's loan program, the LPO. Jigar believes we don't have the right business models. They're both right. They're both wrong. We have the technologies today. We can always use better technologies. But the real question is, how do we basically marry capital to the technologies that we're trying to deploy and do it at scale?
When you compare the US to Europe and Asia on the same topic, how do you see the differences between how they're able to deploy their capital versus us? Does it come back to the same issue of business model, or is there another piece of the puzzle that they're tackling?
It's a good question. A lot of the capital in Europe, for instance, is coming from U.S. institutions, U.S. banks, U.S. you know deployers of capital. So I don't necessarily think that's the right way to frame it. I think the biggest difference between Europe and, say, North America is there's an extra push at the governmental level, at the national government. So France and Germany and the UK plus the EU are all pushing hard on this. It used to be that Europe basically took an approach that, basically a stick. If you don't do something, bad things will happen to you. And the US took a carrot approach. We're going to give you rebates and incentives. To some extent, that has shifted, right? So now Local Law 97, BEPS and BERDO, those are all sticks. Like, if you don't do something, bad things will happen to you. Where Europe is basically added rebates and incentives for heat pumps and, solar, PV at the residential level in the UK. So they're all doing, different things, and they've kind of reversed. There's a lot of action in both. Certainly energy efficiency. I think there's enormous activity in both North America and Europe. I would say solar is probably the biggest place, because the current administration has changed, many of the incentives that relate to solar PV that remain in place in Europe.
We have, with technology like energy analytics and smart building systems, how are you seeing now with the role of PropTech and innovation coming along, how owners are able to better position their assets for long-term competitiveness within the United States?
So the challenge, I think, for the PropTech industry broadly is that most PropTech companies are creating or inventing a product. And products are not solutions. Adding products together, integrating them together, that's what becomes a solution. And I don't think, for instance, most owners necessarily think like, I have an issue with my conference room, I need a sensor for that. Or I need better insulation, because better insulation is only valuable if in fact you have controls and sensors on your HVAC system so it actually stops blowing and stop heating and cooling. And so I think, I would say PropTech founders, the thing that they miss sometimes is who they're selling to. Most want to sell to a building, they want to get to owners, and in many cases they should be selling and marketing to integrators or to controls firms or to somebody who has got a larger contract inside a building. I think we need both. We need lots of bits and pieces, that become bigger things. We need the bigger things to be better positioned. And I think we need the PropTech industry to more broadly understand who they're selling to. Because the reality is lease structure matters. How expenses get reimbursed matters. Cap rate matter a lot. Hold period matters enormously. When you don't understand those things, you don't understand, the person you're trying to sell to.
When you see the mesh of innovation and sustainability, and you take a 5-year outlook, where do you see it coming together in the next 5 years?
Oh, I think, first of all, technological time frame is an enormous amount of time. I think what you're going to see is better software analytics to look at buildings and their energy load and their operations. I think I don't know that you'll see a lot of innovation big innovation on lighting and controls and sensors, or solar PV. I think you'll see pretty significant innovation on storage. And I say storage very specifically because battery is the most ubiquitous, but it's not the only form of storage. Whether it's compressed air or molten sand, at the utility scale, the building scale. I think we're going to see all sorts of different types of innovations. Some will be granular and small, some will be, very significant. But what we do know is that as an industry, we will continue to innovate. What changes the ROIs of technology is the cost of power. The cost of power, particularly for residential customers, has gone up enormously. In some cases, 20, 30, 40% in the last couple of years. And the cost of implementing measures generally has not gone up by that much. It's gone up, but not by that much, which means that the paybacks are getting better. They're coming in. And when you start to sort of think about the lease structure, when you start to think about green lease language that allows you to basically offset or basically lay off part of the capital costs, some of the capex to the occupier, because they're also getting the benefit, then you start to sort of see really interesting things happen. We're seeing that most stakeholders are really aligned on this. Companies want to do it, even companies that don't necessarily believe in climate change, and there are quite a number that don't. Their customers do, their investors do. If you can be to the far right, but if you're a public company, most likely your shareholder base, your top 10 shareholders, are primarily mutual funds who care a lot about this. And so, you don't have to think that it's going to impact your EBITDA, but it is going to impact your shareholding, and who are your shareholders and how much do they own, and that impact on pricing and demand will impact the return for the shareholders.
Much of my work has been across Latin America and seeing where sustainability is, hitting across all the countries there. I'm curious to see if you have any experience across Latin America or what you see of that entire market, because it's a huge region.
Yeah, it's interesting. We've done quite a bit of work in the Caribbean and Mexico, but we also about 10 years ago created a climate data metering program for Montevideo, Uruguay, in conjunction with the Inter-American Development Bank, IDB, or BID in Spanish. And because almost all of the power for Uruguay came from two dams, one they owned with Argentina and one they owned with Brazil, and they were mostly hydro, their base load was completely hydro. And so the overnight, where it just, was very inexpensive. But from 6 to 10 p.m. every day, most of the power, because the demand increased, so much, was coming from a diesel peaker in the middle of Montevideo. What that meant was, at the time, the 5 cents a kWh went to about 32 cents. And not only was it more expensive, but it also had a whole bunch of other negative impacts. Diesel in the middle of downtown, you could smell the diesel, so you had health impairment, pulmonary disease, higher rates of asthma. And what was interesting is that in many cases, people didn't fully appreciate how this was going on. And so we metered a number of public buildings, including the Capitol itself, the Legislativo, the Intendencia, which was the mayor's office, as well as the BID and UTE, which was the utility. Now, the crazy thing is that UTE, the utility for Uruguay, their building, 10-story building, they had 40 people come in to clean it each night. But they didn't go floor by floor and say, everyone's going to clean this floor, and then we're going to turn everything off. No, they had 4 people per floor, and they basically left the entire building on for 8 hours. 4 hours of cleaning, dinner break, another 4 hours, and so they'd get it done. Everything was on. And they could have done the same thing in a different way, but they didn't really think they were, from their point of view, they weren't paying anything because they were the utility, they produced it. So their perception was the marginal cost of power was zero. As we got into it and showed them what we were seeing, they changed their ways. Now, the Intendencia was had a different problem. There was very little controls in the mayor's office. People left at 5 o'clock. They didn't turn anything off. The security guards turned things off, and so the security guards would walk around, and as they got to each floor and each part of the office, they would go into the panel and literally go and turn things off at the box. So everything would go off, which meant everything was on until it was off. And some days they got to it. Some days they got distracted. A friend, they have a tea called in Uruguay that everyone essentially drinks, and they would slow down, they would talk. And what we found as we began to basically meter the building is that there was about a 90-minute delta between best practice and worst practice, and that was enormous. The other thing we saw was at 5 or 6 o'clock in the morning an enormous spike in energy consumption. And what we realized is that because everyone had just expected the security guard to turn things off, no one turned anything off. And so as the security guards came back in the morning and they started turning everything came on. All the printers, all the computers, all the lights, the radios. We were trying to figure this out. We were there one time in the morning, and it was almost like the movie Big, when the character goes to FAO Schwartz and everything's off and then everything's on, and there's just there's lights and there's music and everything's happening. No people, just lots of energy consumption. So I think the same thing is true in Brazil. Brazil, enormous amounts of power come from hydro. The challenge is that they've had a drought for large periods of time, and so that has led to lower energy production as climate has changed. And so they have a number of different types of issues. In other parts of South America, they have a lot of the economy is off grid, mining, for instance. So copper mines and different things like that. And so they're having to create essentially diesel power plants and gensets to power their operations. There probably is a better way to do it, if you were to sort of start it from scratch. But I think the region is beginning to understand it, and certainly with the support of the IDB and some other non NGO stakeholders, including IMF and World Bank, they're making great inroads.
When it comes to scaling impact across Latin America, would you say that the work that the IDB is doing is enough, or should there be also incentives provided at the state, local, and city levels as well?
Oh, I think, do I think it's enough? Absolutely not. There's challenges when you get so much of the funding from a multilateral development bank. It's slower. I don't want to criticize the procurement process, but it's an onerous procurement process. Much of our business is private sector, about half, and the other half is U.S. government, Army Corps of Engineers, cities and states. We love our private sector clients because they move quickly. They're going to own something 3 or 4 years. They don't have time to waste. In multilateral development banks, the MDBs, NGOs, they often, their view of the world is, 12 to 18 months. Time is a little less important to them. So I think it's a combination. You need public sector, you need private sector, you need, commercial banks, you need MDBs, you need everybody. I'm a big believer in all of the above, whether it's on the capital side, whether it's on the generation side, whether it's on the technology side.
Completely agree. I think there needs to be a forced collaboration in order to get the whole world on this same margin. Brad, I have 3 more questions left on this podcast. First one would be, for someone building a durable platform who wants to focus on sustainability, scaling impact on a global level, what would you advise them to do to focus on today with so many tools out there, so many different resources that we can use? What's your best piece of advice to them?
I think that a lot of people start by inventing something and then figure out who needs it, who wants it. I think probably the better way is to basically think about the problem you're trying to solve. The bigger the problem, the better. Climate change, sustainability, decarbonization, however you want to think about it, is a pretty big problem. It's a team sport, though, right? Because nobody's going to solve it by themselves. To get to net zero, it's energy efficiency or demand, it's on-site renewables, it's off-site renewables and offsets. And within those, there are enormous sort of complexities. But I think you want to find the biggest problem you can possibly find, and then find a way to sort of address it. I think the other thing is that you want to look for opportunities to create long-term revenue streams. Energy efficiency and demand don't necessarily do that. There are times where it's perhaps more episodic than long-term, but that would be my advice.
You talked about the tremendous growth that GreenGen had from its inception to 2011 up till now. Where do you see GreenGen in the next 5, 10, or even 15 years?
15 years is a long time. That would mean, because we're just in now wrapping up our 15th year. And so it's hard to perhaps imagine another 15 years. But having said that, what we're excited about right now is that there's been a big shift from talking about it to actually doing it. And the vast majority of the industry is designed to give you a strategy, a plan. Very few firms want to actually execute and implement the plan. That leaves us in good stead. Firms that historically thought of us as competitors, even if we didn't think of them as competitors, are turning to us now to basically ask if we can help implement, if we can help work with them to deliver results to the client, because the client doesn't necessarily, they're not satisfied just with a good plan and strategy. They want it executed, they want it implemented, they want the work carried out. I would say the other thing is that our public sector business, which has been somewhat episodic over the last 10 years, we're now seeing significant growth at the federal level, the U.S. government primarily, Army Corps of Engineers, so it's for DOD. We just won a 5-year contract with the Army Corps of Engineers. We're one of 18 firms on this $3 billion contract. We're the only small business in the country. And we recently brought on the retired 3-star general who's been running the Army's global installations for the last 3 or 4 years. So we're quite bullish about that. But we're also bullish about the work that is occurring at the city level and the state level. One of our contracts is with the state of Maryland through the Maryland Clean Energy Center, MCEC, or the Green Bank, essentially. And we are currently doing a renewables project for a town on the Eastern Shore. And we are recently selected by the governor to do the decarbonization of the Maryland ports, which is the 3rd largest port in America, the 2nd largest port in the East Coast, and it is the primary port for vehicles coming from Europe. It's the biggest roll-on, roll-off terminal in the country.
Brad, if you had to leave us with one more statement with regards to what you would want to see in the industry within the next 5 to 10 years, what would it be?
I would just say we'd want to see more of what we're seeing already. We'd want to see more momentum. We'd want to see acceleration, because the reality is that the biggest investors in the world, the Blackstones, KKRs, the Brookfields that we work with, they get it. They want to work with speed. The amount of money is irrelevant to them. What they care about more is the return on the capital. If you tell them, put $1 in, there's no ROI, the answer is no. If you say, it's a 3-year payback and it's $1 billion, the answer is yes. So they're really focused on the value creation. We love to see just more people doing that. We're seeing great pressure coming from occupiers, customers, sort of all the different parts, all the different stakeholders. And certainly it would be fabulous if the U.S. government, which is certainly the key stakeholder absent from this discussion, would join in. It's not a political question. It's profitable, right? We're ceding to some extent our technological advantage to other countries by disincentivizing this. We want to lead on this. We have the greatest universities in the world. We have the greatest energy labs, the DOE national labs, Oak Ridge, Lawrence Berkeley. These are fabulous places. Every country wants to be here. The scientists from around the world want to collaborate with people who are here. And, it would be great if we had a federal government strategy that recognized that this is not a political issue. This is, an economic issue. And we have all the advantages if we don't cede them to others.
Amazing insights, Brad. Where are people able to find more information about the work that you do and the work that GreenGen does?
Yeah, it's very simple. It's just www.greengen.com, GREENGEN.com. We have a good website. We have lots of case studies. We're easy to find. We're not hiding. LinkedIn is a great place to connect with us. We're very active on thought sharing and making sure that people know what we're doing. We released just yesterday a pre-acquisition due diligence checklist, really to help the industry. We want more people to think about, addressing these issues and identifying these issues up front before they buy a business, whether it's perhaps things that they'll avoid and not make a decision, or simply make sure that the energy related, resiliency and decarbonization related things get into the business plan from the outset. Because when they're at the very beginning, they're more likely to occur.
Thank you, Brad. I appreciate you for coming on the podcast, and it's been a pleasure hearing from you, and I'm really looking forward to seeing the work that GreenGen does in the next 5 to 10 years.
Zeus, you're very welcome. It's been a real pleasure for me as well.
Thank you.